Hey everyone, how's it going? It is 1 p.m. We just got the market close on Tuesday, June 4th. It was a pretty inactive day and not too surprising. That's what we were expecting. We are still in this chop sideways period, and it doesn't look like we have a really good catalyst until next week when we get those CPI and PMI reports. Uh, the exception could be the employment report, but that comes out on Friday. So this week, for now until through Thursday, we're really just going to expect, for the most part, just chopping sideways. It's going to make it a little bit more difficult for our positions to gain, but if we position very carefully and we choose our stocks very carefully, we can still move. Of course, there's no guarantee of that, or that we'll be able to pick a stock that is still moving despite the market chopping sideways. But we always give it our best shot. So as long as we're not losing money outside of randomness, then we're fine. If it's losing money because of randomness, well, randomness should bring us back to break even. So we're just looking for those non-random movements in stocks that are moving non-randomly. Right now, the S&P 500 is just moving randomly. This morning, we were expecting it to move higher because of the forces that we saw in the markets. And we did. So we came and we bounced off of the VWAP a couple times, and then we traded significantly higher off of just before the reports, the JOLTS reports and the manufacturing reports came out. And then they came out, and then we kind of fizzled and went back down. And for the most part, we didn't trade too much. We just stayed within this one region until we finally broke out, and then we traversed one region and then just traded right back down. So overall, we just ended up, I guess in the last 15 minutes or so, we did bounce off of that MA200 and come back up higher. But you can see after markets, we're just coming back down. So this is really random movement. It's just normal market random movement. If we traverse two levels, that's not a lot of volatility. There's not a lot of movement. It's not like this day, we went down 4 and then came back 3. And then the day before was really, really wild that we moved down 4 and then came back 4, 3, 1, 2, 3, yeah, 4, and then came back like 5, 6, or 7. That one was pretty wild. But you can see here, 2, 1. We'll call that 2 because since I haven't drawn a line up here, 2. So 2 is very normal. 2 is very normal movement. 3 or 4 is even normal, but for us, so would be 2. For us to traverse any more than that, any more than 4, I would say, would be very directional inside of the markets. So today is just 2. We're basically chopping sideways. We're only up 0.1% at the close, and we can see that that volume really didn't come back. All we got was that surge on Friday, and then it just disappeared. So there's no conviction, there's no momentum, there's nothing really to give us direction inside the market right now. So we really do need to see a catalyst and something for institutions to dig their feet into so that they can start moving in their chosen direction. For now, chopping sideways. Before we had the possibility or the likelihood of pulling back to the MA50, that is now over. Right now, we are not really neither here nor there. Nothing really to indicate which way we might go, except for maybe anticipations of CPI reports and therefore interest rates and bonds. So if we look at the bonds, they did continue to move higher. They did come up and hit this horizontal line and pop up a little bit and reacted to this MA190. And this is where we saw some resistance. We have historical resistance. I would still call that in the region of this purple line. We ended at 92.66. The purple line we set at 92.50. That's still in the region. 93 would be in the region. But this is about it. We gapped up, surged higher, gapped up, moved higher. And I don't see how the bond market without a catalyst can continue to move upwards. So the things that we had were that PMI report, or well, not the PMI report, whatever the the factory orders today, ISM yesterday, PMI manufacturing, not PMI, but PMI manufacturing yesterday. All of those are showing softness. So consensus was at 0.7. We were at 0.7. The prior is 1.6. They revised it to 0.7, but really, no matter what, it's a downward movement, and or you could call it an equal movement, but I always have a mistrust of revised numbers. So we have a at expectation factory orders, which depending on what you want to believe, it's either flat or down. And then if we look at this RPI, I'm not actually don't even know what the RPI is, so I don't really know. All I know is that we're lower. We underperformed whatever we were expecting. So I should probably read up on RPI, but it's probably not that important if I don't know what it is. Oh, relative performance index. So they're comparing it to a previous performance index. That's a really weird way of doing it. But non-durable, it's on the non-durables. Well, that is lower. Non-durables, which means that they're perishable. There's lower orders for that, meaning that our expectation is that we can't clear out inventory as fast as we could before. So we reduce our orders. So that's not great news. So everything from the manufacturing standpoint is looking softer. So the hope that perhaps the bond market has is that the economy weakens so fast and so much that the Fed is forced to play catch up and stimulate the economy by lowering interest rates. Right now, the Fed stance is that they want a weaker economy in order to bring down or increase unemployment, and reduce a consumer purchasing power, so that helps reduce inflation. It basically reduces demands for goods, and then that reduces inflation. So if we continue to see rapid decline in the economy, then that is an argument that the Fed might cut. But so far, it's just mild. It's not anything crazy in terms of a weakness in the market or in the economy. And really, we would wait to see a GDP report before we really decided that anything was weak. It looks like we might not get one for a while because we got one on May 30th. So we don't really see one coming out anytime soon. But for now, our stance is still based on everything and all the data that we've seen and on all the commentary that the Fed has made, that we're going to expect that this number, this 25 basis cut number for July, is still going to collapse to zero. This went up to 18.5 this morning. When we were looking at it, it said 16.5. So that is reflecting this upward surge in the TLT, and it should be pretty much it. I'd be very surprised if we went significantly higher without any sort of data that showed us that the economy is declining at a very rapid rate. If it's just declining a little bit, then that's within expectation. That's what the Fed is trying to do. But if it looks like it's collapsing on itself, then that would be an argument for the Fed to start lowering interest rates and stimulating again. So outside, let's look at our VIX. The VIX still in this range. We were talking about this. We did not break above this 1375 to 1380 region, and we haven't broken this low. So we're just floating around in this normal area for 2024. We'd really have to get above this high right here, or that it happens to be the MA 200 line, but we don't look at that for volatility. I'm just using that for reference sake. But basically, the top of these two bars, we need to break out of there if we're going to see a spike in a drop in the S&P 500, or we could just float around here and just continue to chop or slowly drift higher or lower. Or if we move significantly lower, then that could mean a movement upward. But really, this VIX doesn't have that much lower to go. We're already at normal levels for 2024. We hit a record low, or at least a multi-year record low over here in December, and also again in May, but that was the normal way back before COVID. And we're not expecting to be in that COVID level of volatility for unless something significantly changes about this market. The market post-COVID is very different because we attracted a lot of retail investors into the market during the COVID times. Number one, we got rid of commissions in the United States. Most brokers don't charge commissions for most trades, or they dramatically reduced their commissions for other types of trades. So that attracted a lot of money in. We have zero commission brokers like Robinhood, where ostensibly you don't pay anything, but you're paying for it in terms of poorer services or your data being sold or other ways that those discount brokers or those zero fee brokers have to have some sort of revenue. So they're not getting it from their traders, so they have to pull it out from somewhere. And in any case, there's a lot of new traders since COVID, and that level of newness or freshness or inexperience in the markets also creates a certain level of volatility. So we really don't expect to come back down to the 7, 8, 9, 10 regions, or at least visit it for very long in the foreseeable future and for multiple years at the very least, unless something else changes in the market that brings us back down to these between the like 10 to 11 region. So for now, we'll just expect to be 12, 13, 14, 15 will be normal. And then at least for the foreseeable future. So earnings, we had CrowdStrike, right? This week, today aftermarket, CrowdStrike and HPE. Let's take a quick look at what those are doing, because those will have an impact on the markets. Let's see if we can get some data on that already. CRWD, way lower, but then looks like recovered maybe? Yeah, recovered. So significantly lower on the announcement, then recovering, and then we are lower, but not hugely lower. So that doesn't look like it'll be, at least so far, doesn't look like it'll be a huge drag on the markets. And then we have HPE higher, just up and then holding steady, maybe looking like it might want to go a little bit higher. So that might help the indices a little bit, but overall, I would say kind of neutral, nothing big or significant. Of course, these both are in the tech sector, and what we're more interested in, in seeing is what happens with some of these discount retailers. So we've got Dollar Tree, it's consumer staples in Campbell's Soup right here. So those tomorrow morning will be more interesting to see. Okay, let's take a look at we might as well look at our momentum levels. We basically already know what to expect. We're gonna see very little momentum because all we're doing is chopping sideways back and forth. So, but we'll take a look at it anyway. So 90-day highs, only 68, 90-day lows, 94. It's a little bit more lows than highs, but really, what was it yesterday? 69, 68. Oh, wait, 60, 92. So they just flip-flopped. One in the 60s, one in the 90s, and then today they flip-flopped. And then on last Friday, we had 113 highs and 36 lows. So not big numbers. And if we don't see big numbers, so basically if we wanted to see momentum, if we saw momentum, we would see these numbers steadily increasing. So instead of this being like 113 and then 90 and then 60 and then 90 and this one being 30, then 90 and then 60, instead of just jumping around like that, what you would see is 100, 150, 200, 300, 350. You'd see them increasing because if a stock is moving and it makes a 90-day high, then tomorrow it makes another 90-day high, and then tomorrow it makes another 90 high, then I know that stock is moving. It's moving upwards with momentum. So the list of stocks that are making those new 90-day highs, it should be steadily increasing if we have momentum. Otherwise, we just see it bounce around, which means that we're hitting a 90-day high and then we're coming back down. And then a different stock is hitting a 90-day high and then it's coming back down. So if I look in this region, so say May 2nd to May 9th, we most likely will see a different story. That was a bit of momentum right there. So if I go from May 2nd, okay, we have 153, 174, 233, 193. Okay, so at least we saw that period of increasing momentum over a few days. And then it looks like we flattened out, and then we hit the 305. And then that's where we flattened out. That was, what is this day? This is the 14th. 14th. Okay, yeah, and then we flattened out. So you see that trend. Now, of course, it's not every single day up, but you see it move up and then go sideways a little bit, then move up, then go sideways a little bit, then move up. So that is what we expect if we are seeing a trend. Otherwise, you're not getting any momentum. You're just chopping back and forth. You're seeing the same numbers or the same region of numbers repeating themselves. So there's that indication that we don't have a lot of momentum going on in the markets. And then we'll take a look. Oh, I should look over here. Over here at our market momentum, overall market momentum. That's every single stock above $2 in the markets, whether it's on the New York Stock Exchange, so not part of an index, just all the stocks listed on the market. You can see that we're below the 50-day moving average, or less than 50% of all stocks are above their 50-day moving average. And then if you look over here on the S&P 500, 47%. And we have healthcare, real estate, communication services, and utilities are the only ones that are above 50%. Healthcare, not that significantly above, but it does look like it's pretty good. It does look like it could start to move higher. So that indicates a safe sector. So it indicates that the market is not really necessarily looking for a strong surge upwards in the overall index. Then we have real estate. That was interest rates. So if our TLT keeps moving up, that's good for real estate because that means interest rates are down or yields are down. And then it makes real estate more attractive because most people borrow in order to get real estate. So XLRE has been benefiting from this wave upwards. It's not looking super strong though. It does look like a bounce right here. It's just not a lot of momentum, especially a low volume. Just not a lot of momentum. The second the TLT starts coming back down, we would expect real estate to come back down as well. So I'd be very careful going long XLRE and also going long home builders. Utilities is a similar story, 97% above their moving average. It is a indication of both safety, but also a reflection of the interest rates. So utilities, most people, they don't buy utilities because they think they're going to go screaming higher. So if we look at this overall trends, Yeah, general it moved up, but not a lot, right? It's not, let's compare this to S&P 500. See, it looks so flat compared to this upward movement in the S&P 500, and then the downward movement in the S&P 500, still flat. Upward movement in the S&P 500 actually going down, upward movement in the S&P 500 moving up with it, but it is much flatter than the S&P 500. People don't go into the utilities because they expect growth. They don't expect to make a bunch of money because the stock doubles or triples. They are sitting there collecting dividend payments in utilities. And if a interest rate environment is looking like, hey, I'm getting less on bonds, then then utilities, the dividend payment on a utility starts to look more attractive. Both are considered very safe assets or very safe sectors, although bonds a little bit more so. So if the bonds start paying more or start yielding more, then XLU starts to look less attractive, and we'll see a sell-off in XLU also. So I'd also be very careful with going into XLU, although it does look good right now. We are in this kind of very choppy period, and if the bonds start moving lower, then that'll drag XLU lower with it. And the other reason is we're at pretty extreme levels in terms of the number of stocks above their MA50, right? It can only get to 100%. We're at basically 97% right now. And so we would expect that sell-off, and that sell-off in the XLU looks like it really sells off. It goes down to like 2%, 4%, 10%, 0%, 5%, so 7%. It looks like it really sells off. So I'd be very, very careful going into XLU. I don't necessarily think that we should be looking at shorts, but eventually we may look at shorts if bonds really look like they're going to break down. We could look at shorts inside the XLU. It's just hard to do it when you still have strength in the market. There's no reason for us to short right now unless we're taking a very long-term view, 6 to 12 month view. We might consider going short in the XLU. Then what was the other one? Communications. XLC going super strong. This looks beautiful. A beautiful, steady upward trend, pull back to the MA90, and then a bounce upwards, making new high right here. And maybe even all-time high. Nope, all-time high was in 2021, but at the very least a 52-week high. There we go. See, 52-week high for sure. So it's been a while. So the all-time high is not that much higher. I guess we already went over this. That's why we put that purple line. It was a few days ago. Oops, that's not what I wanted to do. So 52-week high. Okay, there we go. So it looks like we could reach or challenge that all-time high right now or soon. So XLC actually looks like a good sector to be in long. And we didn't look at sectors yet, but I wouldn't be surprised if out of all the sectors, that one looks the best. SMH pulling back a little is very similar to XLC actually. Made a higher high over here, pulling back a little to the EMA8. That's looking pretty attractive. Home builders, not so much, especially given that we are expecting TLT to come down and drag anything that is interest rate sensitive down with it, including QQQ, including XLK, and sort of including the SMH and XLC. However, with all of the AI hype and all of the interest, the main interest being in AI right now, the SMH and XLC will probably weather the TLT downward movement far, far, far better than something like XHB or real estate or communications. Retail pulling back, that's what we expected. We talked about how it went parabolic, and then we went parabolic again, and that it just didn't seem like there was anything to sustain it, and that we were expecting it to come back down, and we gapped down pretty hard today. Let's see what XRT down 2.07%. Okay. And we've got communications looking great. Financials a little weak. I like that it made a higher high right here, but it's struggling. I would have liked to see it just bounce right back, and then it's starting to struggle a little over here. QQQ is still looking okay, but we have that concern with the interest rates. SPY is looking okay, but really just chopping sideways, not doing a whole bunch. Aerospace and defense is looking good. If it can just make a little bit higher, go a little bit higher, make a new, well, it made a new all-time high yesterday, but a new close higher, then that would go towards, so basically I'm waiting for a confirmation bar. A confirmation bar in the aerospace would make this look very attractive. And then XLK, nice little pullback right here, but we would want to be careful because of the interest rate environment. XLI, all it's doing is chopping sideways. XLU, we already talked about. XLB, similar to I, but a little bit weaker. And then XLV, gaining strength, but not interesting yet. Small caps chopping sideways. Dow Jones showing weakness, chopping sideways for now, but looking like it could drop. XLP looks like it's gaining strength similar to XLV, but we do want to see it challenge that high and break through it before that becomes super interesting. I'm going to make a note to myself to keep an eye on XLP, XLC, and what was the XLV? XLV, okay. And then real estate, we talked about already, showing weakness. XLE, weak, but looks like it might be entering a support area just right down here, not too much lower than where it is. So if we have longer term positions, like 1 month positions on XLE or energy stocks, I wouldn't give up on them yet. It could bounce. If we do break these levels, however, those are the MA200, basically MA200. If we break that MA200, then I would let go of those positions, but a bounce off of the MA200 would not be surprising. XLY looking very weak, similar to real estate. And TLT. TLT, we're expecting it to come down. So really on the bullish side, the interesting ones are XLC and then maybe XLP and XLV somewhat soon. And then to the downside, nothing looks super weak, but we did some of those ones that we had towards the end, like XLY not looking super great. Real estate, I'd probably be looking at those two in terms of the downside. I'm going to make a note to myself on those two as well. Okay, so overall, still neutral on the market. Still expecting sideways chop going into Friday. Friday might change things, but it is also Friday, so we're probably not going to be making huge moves before the weekend, and so we might see things really pick up next week. And let's see, probably Tuesday is generally when the CPI comes out. Okay, Tuesday, nope. Wednesday, here we go, Wednesday. It's coming out on Wednesday. So maybe we're quiet Monday and Tuesday as well, and we'll see if the CPI brings volume back into this market, because the last 3 weeks has just been really quiet, and it's been making for some really uninteresting trading days and and making my job a little bit more difficult because it is harder to find. You really have to find really good quality stocks in order to make money in this environment if you're going by a single option strategy or even a stock strategy. If you're going spreads, it's easier. However, it is getting riskier and riskier. It's getting more and more dangerous to go into spreads and verticals and iron condors because of that low volatility. We're at super low volatility we see that we are in an environment in that S&P 500, we're very near those lows and we should be coming back up. And we don't necessarily need to see this. This was 2020. This was COVID. So if I could erase COVID, then you would see that 2022, 2023, those are all high volatility years. And then 2024, we moved up. And if you see where that dotted horizontal line is, if I just hold at the levels where the highs were in 2024, you can see that in 2019, that was a peak in 2019. It was a peak in 2018. And it was above the levels of 2013, 14, 15, 16, 17. Okay, so this is reflective of what I was saying earlier, where we introduced more volatility after COVID. So right now, the environment that we're in right now, you can see that there's this little tail curling upwards when that ATR, that volatility is increasing, and we would expect it to increase to this 6.79 or 7 region in terms of the number of the ATR. Currently, we're at 5. That increase in ATR can blow out levels. If my market maker says, hey, I have an 80% chance that will be below, I don't know, just 538, let's just say 80% chance that will be below 538. Well, and today the ATR is 5 and I'm at 528, that's 2 ATRs away. But if my ATR goes up to 7, let's say, then I'm only less than 1.5 ATRs away. It makes it much easier for me to hit that level and blow through. And if that's my maximum loss level on my spread, then I'm going to eat that maximum loss. So the ATR moving upwards makes it a lot more dangerous for spreads, for certain spread strategies. So right now is not a great environment overall. No matter what strategy that you're picking, you're having to do it with much more skill if you want to continue to make money or continue to have a high expectation rate. So that's what we're doing. We're in this neutral, bumpy, sideways environment, and we are picking, and we're picking pretty well. So even though we take our losers are very small compared to our winners. Our winners have been over 100%, and our losers have been between 20 and 60%. So we're going to continue to do that. We're going to continue to pick our entries very carefully and continue to stay neutral until we finally get a catalyst that brings volume in. And then once we have volume in, then we'll have volatility. So even if we don't have directionality, we can still go short term. We can go to some of those the more computer algorithmic trades that you've seen me do in the past, where the average hold is 2 or 3 days, and we can just get in and out and collect our profits or until we actually get a trend, and then we can do what we've been doing, which is finding really high quality stocks that are established in a trend, and then those are the times when you make the 1 or 2 or 300% gains. So that's our plan, our strategy: stay neutral, stay nimble for now, because we are in that super choppy environment, and we'll just keep on doing what we're doing and collect our profits. So we'll end it there. I will see you tomorrow morning. Have a wonderful rest of your day.